Okay, folks, good morning, good morning, good morning. If this is your first time here in the questions box, give me a number 1. If you've been here before through my mentorship, no need to tell me. Actually, surprised. There's a lot of you that are new. Or at least you're telling me you're new. I'm not sure. Okay, so what we're going to do is I'm going to be asking for credit card numbers today, social security numbers, and I'm just kidding. I'm not asking you for anything. All right, first things first. We're looking at the Twitter account that I activated, so that way everyone knows that it is me. You can hear my voice. It's at I_am_ICT. So if you've seen it or heard about it and you're watching the video, I wasn't going to record this, but now I'm going to because I think I could answer a couple different things that came by way of email over the weekend. So a lot of it had to do with, is this really me? Because there's 2 goobers on Twitter pretending to be me. But nonetheless, it's me. So I'll be sharing stuff beginning in October. I just want to get the Twitter account activated, let everybody know it's me. And that's about it as far as that goes. It's pretty self-explanatory. I'm not going to be doing the stupid stuff I did in the past where I was trolling other people. So if you're looking for that, unfortunately, that won't be there. I'll just be talking about the markets and whatever else goes on in the charts. All right, so let's go over to MT4. That way I can get started on the things I want to discuss this morning. Now, admittedly, I'm a little rusty because I've been away from live sessions for a couple weeks. I'm used to doing it on a day-by-day basis, but I've taken some time off because I've been burnt out. But I want to kind of like give the opportunity to voice my opinion on some of the things that I think plague traders in terms of bad habits. Actually, I'll refer to some of the things I've done from the beginning back in the 90s when I first started as a trader. And one of the things that I think, if you first tackle it, and I'll talk about it before we close today's session, if we can overcome this one particular habit, I think that would be a huge milestone for everyone's trading. And it even doesn't matter if you're a new trader or if you're someone that's been trading for a long time. There's one particular habit that always plagues everyone. And I'm not suggesting that I have figured it out for everyone, but I'll just give you my suggestion on how I personally overcome it, or at least battle it. All right, so when we're considering trading, obviously the beginning or genesis of everything is you have to have an idea of what you're going to act on. Everyone first gets into this business and they want to think about how much money they're going to make. They don't take any consideration into how much money they're going to lose or weather in terms of adversity. So obviously that's the first habit that becomes a bad habit, is expectations. And the unfortunate thing for me is when I first started, I had initial luck, and everyone knows the storyline. I'm not going to rehash all that, but the barrier at which begins to build in a trader's mind is as soon as they have initial luck, like for instance I had, you start thinking you know more than you really do. You start thinking that you're better than you really are, and that was all what I experienced in the beginning. So I don't want to have this session without at least bringing that up first, because a lot of you may be new. I don't know what your length of trading or how long you've been doing it. Just for record's sake, I can't see it now because I'm not looking at it, but if you don't mind, in the comment section or question box, just tell me how long you've been trading or when you first started doing it, and that'll just give me some feedback. I can't read it all here while we're doing it because there's a lot of things that's posting. I had to close the questions box so I can keep my train of thought. But the low expectation approach, I think, is the best way because it allows a lot of room to grow. What you think you're going to be able to do when you first start or before you start is going to be strongly contrasted by what you see in reality. In other words, everyone has this rose petal colored glasses perspective. They're never going to have a problem because they feel hyped up. They get encouraged by whoever's told them that, this is how you make money. Even myself, I've been guilty of that because of the things I promoted on baby pips and my tutorials and everything that I created around the buzz of trading, everyone subscribes to the idea that they're only going to make money, forgetting the very first post I put on there talking about how everyone blows it, including myself. I've won several accounts. And it wasn't just an Forex account. You know, I've dusted a commodity account or two. So if you have these unrealistic expectations, you're going to quit your job in 30 days or within a year, and your chances are you're not going to do that, because you're going to do things to try to rush to that objective. And if you have initial luck, chances are you're probably going to do a lot more leverage. You're going to be doing a lot more trading, your frequency, and you're going to be doing things that are probably going to be outside the scope of what you originally sat down with in terms of a trading plan. And if you've traded, at least with live money, you know exactly what I mean by saying all those things, and you've probably done a laundry list of things beyond that. But today's topic, I kind of want to talk about bad habits and breaking them. And I only want to speak in terms of myself, okay, because it's very easy for me to sit back here and armchair quarterback everyone else I see around the world and on social media and on forums and all that stuff. And I've done that before. And I kind of want to divert away from that. While it was fun, admittedly, at the time, I don't want to do that again. Okay, so I'm just going to keep the focus on me, so that way you guys can hear what I had to go through, what I did, and how to compensate for those things. And I'll kind of give you an idea what you can do with it in the marketplace, so that way you leave today with something that's useful, not just rhetoric. So number one, you have to have your expectations in line with reality. You're not going to be, George Soros and own the whole currency markets, okay, and then subjugate the world as a master puppeteer, pulling strings, causing all kinds of ruckus around the world now because he's so loaded. And you're not going to be Warren Buffett either. So you have to be just you. And you don't know what the trader's going to be that resides in you, but you have to give that trader, he or she, the room to grow. So number one, the first habit you need to break is rushing. And I've taught this in nauseum ever since I began online talking about trading. The first one you have to conquer is the impatience. That's it. That's the biggest bad habit every trader has. Impatience. Impatience of a setup. Impatience of getting in your trade, waiting for that pattern you look for. Okay, that is the biggest barrier to being consistent. And patience is the hardest thing to develop, because you can't develop discipline until your patience is honed first. So it's the biggest barrier. It's not a brick wall. It's an iron wall, okay? And you literally have to find a way around it, because you're not breaking through it. You've got to go around it. That means the journey you thought was going to be short from A to B is now been extended, because you don't know how long your personal experience is going to take you to the left or the right around that iron wall of impatience. It's not going to be where you're at when you first started and then you go to the next stage of independence or financially independent. It doesn't work like that. It feels like that when you watch people online teaching or talking about what they're going to do, or if they have a service, or they have a mentorship. Like myself, everyone thinks that the mentorship was going to be easy. They just plug in and this is the information and they get instant wealth, and it doesn't work like that. It's a lot more work than the free tutorials work. And believe me, if they were talking about what they learned, they would tell you rather, it's a lot more work. So the other side of it is, yes, you have the impatience factor you have to overcome, but then you have to have work ethic. You can't be lazy. You cannot be lazy, because the markets do not reward laziness. Now, it does reward stupidity. I am a poster child for that, because in the beginning, I had no idea what I was doing, and I was gifted, okay, either by charity or, the financial gods were playing, I don't know. It was just all the things lined up when I first started, and I was only buying, and I made money doing that only. But then suddenly the markets turned into a trader's market, and I couldn't make a penny. Everything I did I was losing, which leads me to the next bad habit. When you take a loss, you cannot take it personally. It's a cost of business. And if you are allowing, even in a demo account, because I've talked to so many people around the world, they have been very honest with me and told me that even when they have a demo loss, it's debilitating. It totally fries their brain. It's like they don't want to even endure that. And that's a big, big problem. That means you have a complex with being right or wrong, and possibly over leveraging, even in the demo account, because everybody wants to see how much they could make, maximizing the total amount of leverage they can use on a demo account, but not understanding or respecting the level of financial risk that you're incurring if you were doing that with live funds. No one would be doing that with live funds in their right mind. Now, people do it, but like I said, in their right mind, they wouldn't do it. So they're either blinded by unrealistic expectations, or they're impatient about leaving the rat race. And believe me, I know that feeling. I wanted to get out of the job I was doing. 90s was killing me. I wanted to get out of it. So yes, the financial markets can bring those things to fruition. You can leave your job and replace it with this job, because it's not what everyone thinks it is. Okay, it's not, well, I'm going to sit home and relax. I'm going to kick back and not worry about anything. No, you're worrying all the time. You may not have the same degree of worry and anxiety that every other trader has that's even making money, but you still have replaced what you're doing at a 9 to 5 with a job. And the perspective is you're leaving a 9 to 5 schedule, but it's defined. You know when you have to be at work, and you know when you have to leave work. So you have limitations and parameters. You know your off days, you know your times of service where you have to be there, and give your time for money. Trading isn't like that. You don't have a schedule. You don't know if the London session is going to give you a trade. You don't know if the New York session is going to give you a trade. So the idea or perspective of going into this business thinking, well, I want the trader's lifestyle. Most of you, if you understood what it was, would not want the trader's lifestyle, because it's so uncertain, especially as a new trader, because you don't even know what you're going to do once you start trading. You don't know what your reaction is going to be when you have 5 winning trades in a row. I can tell you what it's probably going to do. You're going to over leverage. You're going to be in a rush to get that 6th trade. Let me check out the questions, but make sure you guys are engaging. Give me a 1 if you have had a series of winning trades, and let's say 5 winning trades, and you feel rushed to get in there to do the next one because you've had 5 winning trades. You want to get in and get that feeling again because you're addicted to that high. See, I mean, if everyone's giving me a 1, and some of them are being commented, they're commenting even beyond number 1. They're saying it's me, that's me. So no one's controlling you. The markets are just moving around, but in your mind, okay, you're creating all these if-then scenarios. Well, I should have held on to that trade a little bit longer. Let me buy it again. Or it's been up. It's been going up for a while. It's a nice move. I don't want to buy it here, so now I have to short it because I got to get back in again because I can make more money. And the worst thing you can do is fall into that trap. You have to have very low objectives in the beginning, because if you don't do that, number 1, you're going to chase profits, and that's how they get you. Everyone knows what it feels like to get the thing right, where they made the right move. They bought or they sold, and it moved in their favor. It's even worse, okay, if you're new and you don't know what you're doing, and it didn't even have any drawdown, because all of a sudden now you figured it out. You're now an oracle. You want to go out and start a Twitter account. You want to go on Facebook, Instagram. Now you know what's going on. And chances are you might have a string of losses, okay, that come, but you're not going to pay attention to them, where that's where your learning is going to occur. The losses is what teach you. And the other habit I'm going to talk about is how I focused initially on what I was doing right. When I was making money, when I had the trade ideas right, even when I was paper trading as a commodity trader when I first started, when I would be right, I focused on why I was right. And every time I was wrong, I ignored it because I didn't want to see it. I didn't want to talk about it. I wanted to pretend it didn't even happen. And that is a death trap. You cannot have that mindset as a trader. You got to go into this thinking, all right, now if I have adversity and I get knocked out of a trade, or a trade doesn't pan out, that's my opportunity. That's that big neon sign, because everyone looks at the marketplace and the charts for the neon sign to pop off for the entries. But the real trader's mindset is, if they have a loss, if they incur adversity, or the idea doesn't pan out or come to fruition, that in itself is the part where you have to dig in deeper and find out what you didn't see or what you misinterpreted. And the problem with that is you have to overcome, number 1, the initial shock and awe of understanding that you're human. Okay, everyone thinks that I have sparks shooting out my ass and I wear a cape every day and I'm bulletproof and I can leap tall buildings in a single bound. Look, 800 people saw if I sit down every single trading day, I cannot be right every single trading day. I said that in the beginning. You can't be that person. No one's going to be that person. But there is a framework that you can arrive at that allows you to see setups that, number one, fits your trade psyche, your personality, and the time that you can be available for the marketplace. Not everyone can be a swing trader. Not everyone can be a short-term trader or a day trader. It has to fit the way you live your life. Are you a quick decision maker? You fly off at the handle real quick? You get happy? You swing back and forth real quick? That's a scalper or day trader's mindset. You would do very well with that. If you're real lazy and you're lethargic and you just can't come up with an idea right away, yeah, you're a position trader. Because chances are you're not going to be swayed back and forth once you get a decision. Once you arrive at an opinion about what you think the market's going to do, the chances are you're going to be so lazy about changing your opinion, you're just going to stick with that. And that's a perfect role for someone that doesn't have a lot of ambition. And believe me, there's a lot of people that make tons of money being lazy as a long-term trader, but they has to have a model that matches that, because some people just can't get it, can't get it together. They can't get motivated. They don't want to do a lot of work. And there's ways to do that, but it's very passive investing and you're not very active. Doesn't mean you can't be profitable. It just means that you have to wait a long time to see the returns. So it is give and take there. But if you are seeing profitable trades, you want to spend far less time worrying about them because you can't make any more money than you've already made on it. But you can take away lessons and experience from the losses. And the worst thing you can do is push them to the side and say to yourself, okay, I took a loss. That's part of the business. I know that. It's cliche. And I'm just going to go to my next trade. No, not as a new trader. Eventually when you're matured and you know that that is, in fact, what goes on, you take a loss and that's part of it. If you're new, and when I say new, 3 years or less, okay, to me, you're a neophyte still. You just don't know everything you need to know about yourself personally. You don't know what the markets have done. You don't have a track record enough to warrant saying that you're anything but a neophyte. I mean, 3 years is, to me, that's the minimum threshold. Then you're experienced. That's all. It doesn't mean that you've matured. It just means you have some experience. Some of these folks that get out here, they go into a demo account in 6 weeks because they've done something, a profit in a demo account. They suddenly want to start their own advisory services. And you know what I'm talking about. Well, long and short of it is, if you have losses, that's where you have to roll your sleeves up and dig in and see where you got it wrong or what you're missing. And one of the biggest things I personally did was ignore all the losing trades I had as a beginning commodity trader. I didn't understand, and what it was actually teaching me was shorting, but I was afraid of shorting because I didn't understand the concept. How can you sell something you don't own? Long and short of it is, once I had my ass kicked enough times, I had to force myself to say, okay, look, I'm now definitely afraid of taking a trade. I was at one point in time afraid to take a trade. In the beginning, I wasn't afraid of anything. Now today, I'm still not afraid to take anything. I can get in, no problem. The problem, and I'll talk about taking profits as a bad habit later on, but I had a moment in my career when I was beginning and coming up where, because I was taking losses, I got trader's paralysis, where I could see something that would be there, but as soon as I got the idea that I thought it was going to trade higher, because I was only a buyer, I was a bull market trader when I first started, I couldn't take the trade because I was afraid of the loss, because I was losing lots of money, tons of money. And some of it was annual salaries, typical American annual salary in a trade. That's how bad it was. And because I was hemorrhaging money, I didn't want to endure any of that anymore, or even endure the uncertainty of just being in the trade, because you know what that feels like in a demo. We'll see what it works out to be. If it's profitable, I look great. I feel good. If it's wrong, I just ignore it. It didn't happen. It didn't take any money from me. And you know exactly what that feels like as well. That does not happen when you trade with live funds. As soon as you put the money at work, regardless if it's a micro account or a mini or a standard lot account, as soon as you put that trade on, something physiologically changes in your brain, because now your ass is on the line. You have real loss. It's going to take money from you. If it puts money in your account, that's great. But suddenly everything changes. It's a paradigm shift. Whereas as a demo trader, You're thinking, how much money can I make? And I don't care what it's going to take in terms of a loss because I don't feel it. When you put a trade on with live funds, it reverses. Now you're thinking, holy shit, how much money am I going to lose on this trade? I'm afraid constantly. And you're not worrying about what you can make. That's where you're supposed to be focusing on. Where's the market going? That's the part you need to be studying, not worrying about the fear of losing. Your stop loss is going to take care of that. If you put a stop loss in, that's its job. Let it do it. You're paying it good money to do it, so let it do its job. You need to be focusing on where is the market going. That's your job as a trader, managing that. The risk is defined once you put your stop loss in. Unless it gaps through and there's conditions like that that occur, that's the risk every one of us take. But you have to know what it is. Hang on. You have to know what the objective is for your trading plan or your objective and your trade idea, and focus on that when you're in live funds. But the problem is, and give me a 1 if this is happening for you, if you're now in live funds, you're thinking only about the fear of getting stopped out and how much that's going to hurt your account, versus when you got in the trade, is it still going to your objective and managing that? Again, everybody, one, it's all flying right now. So the long and short of it is, that's a normal thing, but the reason why that occurs is, number one, your chances are you're using too much risk. You have way too much leverage, and your stop loss is probably too tight. Excuse me. So many times I've sat down with individuals because they watch people on Facebook or they have Twitter accounts, and people they'll put a trade up, okay? They'll put a trade on and share it online, and initially they probably didn't have a stop loss on at all, but they waited till the trade got into their in their direction, and then they put a stop loss in, making it seem as if they had a 4 pip stop loss. Come on, I'm going to call it bullshit right there. It's bogus. Okay, no one's trading consistently with 5 pip stop losses. It's not happening. Believe me, it's not happening, because they can do that in a demo, but when you put it in a live account, 5 pips is a standard spread variance that they can do. It's legal. They can spread that open and grab your order, and believe me, that's exactly what would happen if you had that order in a live account. They're not trading with these sub 10 pip stop losses. It's not happening. Not consistently, not. Now, can I sit here and say I've done that? I've done it, yes, but not enough to make the case that I believe that, number one, it warrants superiority, because it doesn't. These markets are so engineered to screw you. You're asking for it when you have that. My stop losses generally are 20 pips to 30 pips. That's about it. And I want to know that I have enough room, number one, to allow myself to be human, okay? And this is the next habit you need to overcome. Avoid this notion that you have to have the absolute best entry and the absolute best exit, because you're never going to get that. It's never going to happen for you. The markets are so diverse and rich with volatility, especially the asset classes that we're primarily dealing with today is Forex. But it kind of bleeds across all of them. It's not limited just to Forex, but long and short is, you don't want to focus on or demand, if you will, the absolute best lowest low or highest high for your entry. You just need to have a setup that gives you the criteria to make a profitable move between those 2 points. Now, you have to be able to identify them. Okay, what's an ideal entry point? Okay, and chances are you might get that once in a while or get very close to it, but you don't need that price level. You don't need it. You need to have the ability to determine or decipher where price is right now, and within a reasonable amount of time, whatever fits your trader's perspective, and that may be different for all of us. It may be 10 minutes for a scalper. It may be a trading session or a day for day traders, or for a short-term trader, it could be a couple days, in terms of how I trade, one shot, one kill, or as a swing trader where you're trading for weeks up to a month. And then for position traders where it's multi-months in terms of duration that you're in a trade. But you have to be able to frame that idea where you believe the price is right now, if it's undervalued or overvalued or oversold, however you want to call it. If you believe it's going to go higher, how far away are we right now in terms of price, and where you believe price will be at a later time? Number one, you have to define the length of time that fits your trader mindset. And that I can't give you that answer. That has to be done by yourself. No one can give that answer to you. And that's why I think that for the most part, when people try to give trading signals or trading models or plans, they're plagued to fail because you're trying to get a wooden square peg to go into a triangle hole, and it ain't going to work. Okay, and it'll be frustrating for that person to constantly try to make that adjustment, and it's not going to happen for most. The problem is sometimes you can find a person that can make that adjustment or it fits them perfectly. And marketers and people that sell things, they will focus on them. That's their trick pony. They'll go out and parade them around, and that's why you have only one student or two students at most. And no one ever comes up to that level of understanding or aptitude because it's too hard to form fit this stuff. This is such a hard thing to do. Even though it's so easy, it's either going to go up or it's going to go down or it's going to go nowhere. And you get to decide what you're doing. Why are so many people failing? Because of the thing that resides between your ears. That little 7-pound universe, okay, gets in the way. It's so wonderfully designed to be able to crunch numbers. It's processing power. The brain is what I'm talking about for those that aren't really paying attention. That organ in our body is such a wonderful resource, but it's also our biggest adversary because we have fed it all the wrong things, toxic thinking. When you're in a demo account, you're focusing on the stimuli that makes you feel smart. You want to do the rewarding scenario, the routine where I buy it, it goes up, I was right, this is how much money I would have made. Pay your car payment with that. You can't, but that's reality. So why aren't you thinking that way? And when you have a demo loss, when you have a loss in your demo, you should be thinking, shit, they would have took that much money from me. And then now, what are you thinking? If that was real money coming into your account, you're thinking, okay, I got to get that back right away, right? Wrong. That's not what traders do. Traders' first perspective is as soon as they have a loss, regardless of the size of the loss, what is a consistently profitable trader's mindset immediately going to at the time of a loss? Once the stop loss has happened, what is a mature trader's mindset? What do you think they're thinking immediately? Got to get it back. I need to get in the next trade. One person saying, why did I lose? I'm not seeing what you should be thinking yet, though. Number one rule is if you had a loss, you got to stop. Do not rush back in to take another trade. Don't ever take a loss and feel like you have to go back in and get it right away. That is a huge mistake. You cannot get your money back right away every time. Even though you think you got time of the day, the markets may be moving around, may be volatile, okay? It does not equate to opportunity for you to get your money back. You may have to wait a day or two, and there's nothing wrong with that. That's normal. The problem is if you're new to this and you've just started trading prematurely in live funds, the human tendency is, I want to get my money back right now. Because immediately what you're thinking is, I shouldn't have never done this. I should have never traded with live funds. I want to get my money back. I want to close my account. And this could probably happen with just a $200 loss. I mean, it's such a minute amount of money, but you're all thinking it. Believe me, the first loss you're taking with live funds is regret. I want to get my money back. I want to at least get back to the point where if I want to close my account, I didn't lose anything. I don't want to do this again. Everyone feels that. Their first live account loss, that's what you're feeling. You won't probably admit to it, but that's exactly what you're thinking. So you have to have that mindset as a mature trader because that string of losses that blows your account all starts with that one first losing trade and how you react and you respond to that loss. Everyone goes into a tailspin at some time and loses. You're never going to get it right. But if you take the initiative to say, I've taken a loss, I cannot lose any more money, I'm already out of the money, I'm already out of the account, the trade, my account's at static, it's not moving now. The market's moving around, but my equity is not moving. I am not in a hurry to get that money back. I want to take a breath, take a step back away from the marketplace and say, okay, what did I do wrong? And is the trade still viable? If it is, paper trade that. Do not go back in with live funds. And this is for people that have less than 3 years experience, because chances are you're going to see that you're going to be very emotional about getting in to get your money back. And emotions aren't always clarity in terms of analysis. Either you're irrationally excited or you're fearful. There are two things as a new trader. And chances are it's the first, not the latter. You're not worrying about losing money as a new trader. You're worrying about how much money you're going to make. And that's not what you should be doing. How much money can you lose? Because everyone goes out the same way, busted. Very rarely does anybody retire wealthy. They go in with the expectation of having that as the outcome, but everyone leaves this game the same way, with less than they started. Think about it. So you know that's the likelihood of the scenario when you get into this business. So if you cannot control yourself, believe me, the market will help you, okay? It will help you lose your mind, okay? If you came into a lack of control and discipline, it will help you do a better job of that. It'll give you perfect opportunities to do that. And yet little 7-pound universe between your ears, your brain, it's going to also fill in those gaps when the marketplace isn't providing those little stimuli to get in because the RSI is doing this, or get in because the moving average is crossed over there. When all these things happen, you're going to be looking at, all right, hang on here one second. You got one more chance, Bubba, and you're going. So you cannot force yourself to get back in to get your money right away. Won't happen. Can't happen. If you do, you're going to be bringing yourself to a level of novice, and you're going to stay and you're going to reside in that thought process the rest of your trading career, which may be very short-lived. If you relax and go about taking the loss and saying, okay, I took the loss, I can't go past this anymore in terms of losing money. It's already taken the money out of my account. What should I do now? The bad habit is going back in and trying to get it right away. You can't do that. The best way and the mature way is, okay, I've taken a loss. I'm not going to do any more today. I'm going to sit back. And if I still think the trade's viable, I'm going to, in my mind, paper trade and say, had I done it? And what's going to happen is you're going to teach yourself, number one, if it was another losing trade, it doesn't pan out as you thought, you didn't incur any more live money loss or a demo loss. But it's going to teach you an opportunity to go in and dig in. What is it you're seeing? Because there's a lot of times we feed into these ideas of what you think the market's going to do. Okay, if we think the market's going to go higher, you'll come up with all these excuses as to why you believe it's going to be there. You'll paint the picture. You'll give yourself all the evidences in your mind why it's there, and you sell the idea to yourself, which is the reason why I think, and the other bad habit is spending too much time in the charts. Either your setup that you look for and you trust is either there or it's not. Sitting in front of the charts all day long is not going to make that formation occur. So investing way too much time, way too much effort, okay, in terms of looking at price action, unless you're studying just simple price action, but looking for a setup, you don't want to spend a whole lot of time. It's either there or it's not. It's black and white in terms of that. That's about the only absolution there is in trading, except for losing money. You're going to absolutely lose money. Guaranteed it's going to happen. It happens to everyone. You can't escape. It's like death. But if you know what your setup is, you don't spend that much time looking at it. You know what you're looking for. Okay, so that's the other, I'm going to close it with this bad habit, is not having an idea of what it is you want to operate on. Like, what is the trading pattern that you look for? Now, when I first came out on Baby Pips, the first thing I taught was optimal trade entry. And there's no mystery there. There's no alchemy, nothing new. It's a standard 62 to 79 retracement level that typically happens in market retracements. That's all it is. And in terms of a bias, okay, looking at things like the move here, up and then back, this move here is what you have to internalize in terms of price action. This is what it looks like conceptually. The market rallies away. Right about here, excuse me, right about in here, this is where all the traders on social media and on forums, they will say, okay, I'm buying. I think that the cable, which is what we're going to show here, British pound versus US dollar, right about here, that's where the retail-minded traders are going to be looking to buy. Because why? What would they look back here and see? In their mind, they see this as confirmation. So that means that it's confirmed that it's going up. Well, yes, it's already gone up. So retail, they'll buy in here. And without a doubt, and you've all experienced this, you buy it and it retraces deeper. Chances are well beyond what your stop losses would have been had you used them, or to your stop loss, okay, because you've used something down in here, or maybe you've used a 50% retracement level because you watched some guy on the forum say everything should be below the 50% level in stop losses, and it goes down to 62 to 79% retracement, and then does something to the effect of creating another short-term low and then rallies. So if you can't see your pattern or even identify and define it, that's a problem. That's a habit, because what you're doing is you're reacting to price. You're doing what everyone else is doing. They're watching it go up after it's gone up a certain number of pips, and it could be a completely wide variety of terms of range of what everyone would be willing to see in terms of providing quote-unquote confirmation. You don't need confirmation if you're going to be consistently trading profitably. You need to have a setup, and you need to be trading in the opposite direction you intend to profit in. In other words, if you're looking to go long, you have to be buying when price is dropping. If you don't learn to do that in Forex, you're going to sit through a lot of drawdown. You're going to be very hard-pressed to have to endure before your dealer spread is covered, and you're going to get stopped out a lot. So you want to be anticipating this type of move. So obviously you have to come up with a framework that provides bullishness. For some of you, you might like trend lines. Okay, you might have a trend line that you see on a monthly and a weekly chart, and you think that it's bullish. Okay, I'm not going to argue and say that you can't make money with it. I just don't personally believe in them. But if that's what you believe, you know, that's your bias that leads you to believe you're bullish on cable. Fine, great. What you would look for is you want to see this willingness to go up. Okay, I taught this in the Snipers series and Precision Trading Concepts. They're free tutorial stuff. So I'm not teaching you anything in terms of the mentorship stuff here. But the general premise is you want to see this displacement in the marketplace where there's an underlying willingness to go higher. And we see that in price. So when price rallies, and this could be on all time frames, it's not limited to any one particular time frame, but when price rallies, you want to wait for that retracement back. Identify, you know, what those levels are going to be based on running a fib from the low up to the high, because you're bullish. So when you have that, you'll get this Fibonacci laid over top of your price swing, and right in here, in this little area, this is what you'd look for your setup. So the habit you want to overcome is staring at the charts blindly, not knowing what it is that you should be looking for. Right in here is the setup. You can see how price will, you can see it now with the candles here, so I'm going to change the color of the background with the candles so you can see exactly what happened. But this is a sweet spot. There's no magic in that level. It's simply the 70.5 level on the Fibonacci, 70.5, okay, and that level is what I taught on baby pips from 2010 on until I finally left there. This was the level I like to see price trade to. Just for completeness sake, and because I'm sure everyone's wanting to know, do I buy on retracements at the 70.5 or the 62% retracement level or the 79% retracement level? Like I taught on baby pips, I try to get my entry at the 62. I don't know if it's going to go down to the 70.5 or the 79. I don't know that. No one knows that. So because I trade with a higher time frame model in mind, I'm already allowing myself to have some measure of drawdown from my entry. I'm comfortable with that because it's expected. It's built into my model. So I don't freak out if I buy it to 62 and it goes down to 70.5 or to 79, because I've allowed the trading and the gearing on that trade to permit that in terms of the risk. It's not going to hurt my account that much, even if it trades beyond it and stops me. The next point is this is where you would look for your entry. Okay, that part's done. That's the easy part. It doesn't feel like it's the easy part. Everyone else is struggling with that. I'm going to tell you now what the hard part is. Where do you get out? You have to know where you're getting out at. This is what gives you your risk to reward models if you believe in that myth. Okay, if we know that this is the retracement level and this is where we're trying to buy at, okay, if this is our entry, how much are we willing to hold the trade for? Now notice what I said there. I did not say how much is your risk to reward going to be, because that's speaking in absolutions, and everyone knows what it's like when you get into trade. The market may do something once it gets up to here. Okay, it may give signs and evidences that it doesn't want to go beyond this high here. So is the risk to reward model still the same? Hell no. It's going out the window, because now you have wrestled and now are wrestling with emotions, psychology. I have profits now. Do I want to hold on to the full position? No. Forget about it. Real traders learn to scale out. They do. In other words, let's say it this way. Real, consistently profitable traders learn to scale out. Those individuals that teach on social media that scaling out is stupid because your risk is the highest at the beginning and you're taking smaller profits along the way. Now, forget what everyone else is saying, because they just said what everyone else is not doing. Taking profits is what everyone can't do. The 90% plus club is not profiting. So those individuals are commenting on how people are doing it wrong, taking profits. You are not taking anything negatively out of your trading by taking profit. You're investing, you're depositing, where everyone else is getting withdrawals from their account. You're depositing. You're here in this industry to make money. You're not in here to look good. You're not in here to be smarter than the next guy. You want to be profitable. You put this much money in the account. Your idea is you want to have more than you did when you first started. How much time is it going to take to get to that number you have as a goal? I don't know. You don't know. But you have to have at least an initial comfort level of where you think reasonably the market may go. How do you do that? Well, this is the impulse price swing that I taught for displacement in the sniper series. Then you wait for the retracement back down. In the 62 to 79% retracement level in a bullish market environment, and again, I'll leave that to you, what makes the market bullish, and I've given you several different reasons why you can expect markets to go higher or lower in the sniper series and my free tutorial. So if we know that it's most likely going to go higher, where do we look to get out? Where's a target level, or where's several targets? Okay, so we can consider taking multiple scaling out profits. The high down to the anticipated low here, that's the low in the price. I'm going to use the 70.5 level right there. So what I did was I drew the high down to the 70.5 level. Right in here, this is going to be a target. Okay, and we always use the high that it retraces from, because it can just go right to that point. And that's a real good level to take some profits at. Here's another objective, and here's another objective. Okay, so now we have our entry. That's easy. That's the easy part. We know where it's most likely going to go. If it's bullish, it's going to go back and retest this high. And then we want to see if it has a willingness to go higher. That's this one. And here. And right about here, that's about as high as I would like to go. Okay, because this could be, and remember, I taught this in my free stuff, the reflection pattern, where we have a high, short-term high, and then market trades through that to some degree and creates like a mirror version of optimal trade entry for a sell by making a higher high. It becomes a turtle soup sell and goes lower. I have that in mind. Every time the market trades to a new high or a new low, I'm thinking take some profits. The other traders are thinking it's a breakout, it's going to continue, not me. Liquidity is resting above old highs and below old lows. So there are liquidity pools. If we can now frame an entry, frame targets here and here, okay, I like to take something ahead of the high, because I've seen many times in my trading, it may not get back there. It could create a lower high here, fail, and go lower. So that's why in here, what I do is I take another fib and I draw from the high down to the entry, and where 79% retracement level is here, and I'll show you what that looks like here. Let me get this off. The high retracement down to the entry point of 70.5. Right in here is 79% retracement level. I like to take profit and scale right there. Why? Because I could be wrong. It could trade up to there, fail, and go lower and reverse. Now think about what I just gave you. I gave you a way of still profiting when you're wrong. Because the idea and premise is this high should break because it's bullish. But there's nothing saying that's going to happen. That's not going to always happen. So here's your objectives. This is what you're left with. At least this is how I do it. You get down here. How much of a range do you have from first profit? From here to here, because that's my first target. And everyone saw this happening when I was doing my mentorship. If I had a trade that was panning out, I was taking profits ahead of where I thought the market was going to go. Now, to a lesser matured mindset, when they see this, they think, oh, he doesn't have the discipline to hold out for his trade idea. And that tells me a whole lot about that person that makes those comments, because they aren't profitable. They're not, because they're holding for all of it. They want every piece of the pie. And you cannot do this consistently, because their markets are going to move around. You don't know if they're going to drop a bomb in North Korea and cause the markets to have a ripple. So how can you, with any degree of absolute certainty, know that the market's going to go back to the old high? Just because you think it's bullish doesn't mean it's going to happen. So you have to build in models that allow you to still be profitable, even if you're wrong. So the idea is that I want to go back to this old high from my entry down here. If it gets back to this high here, that's a level where I can take profits. But it may not get there. But if it does, great. I want to see if it can go to the next level, which is 127 extension and then 162 extension. That's what these levels are. Okay. So now, with this in mind, we can frame from this point here to my first target, how much could I reasonably expect to make? Is that enough in terms of pips? If it's like 10 pips, that's not a trade for me. If this is like 30 pips or 40 pips, then yes, that's a trade for me. My personal model, my personal tastes, because it allows me to make enough money in terms of movement, magnitude of price move, and it gives me enough to profit. I can take half the position off here, okay, and take a portion at the high, take a portion off here, and a portion off here. And the moral victory of knowing it went to the ultimate high, that's what I get. I do not always get full entry, full exit where I say it's going to go. That's not happening all the time. Rarely, if ever, is it happening like that. I know by looking at a trade like this, it gives me framework. So now if I have this in mind, I have my entry I want to get in at, I haven't done anything, this is the things I'm doing, and these are the things that you have to do. If you don't do this, you're going to have your trading filled with bad habits. This is the good habit that you have to do. So this is how you frame a trade. You set it up for entry. You define where your objectives are to get out. And now once you understand this, now you can determine what your risk is. Then that also makes or breaks the trade for you. So now you have to look at how much can I make here in terms of pips, and how does that relate to putting a stop loss right at this low here. Now, trading circles will say, you got to go down here like 10 pips below this low. Not me. I don't want to have that. If I believe that I have 40 pips or say 60 pips here, okay, in terms of range, because I'm not looking over here in terms of the actual cable movement. I'm giving you a kind of like a blanket concept to use on all time frames. But if we get like a range of 60 pips here, okay, and I know some of you are looking at it, it's not 60 pips, Michael, but the long and short of this is if that's the range that we have here, 40 to 60 pips. If we buy here, we're buying it as it drops down, not once it starts going up. You don't need to do that. You want to be buying it as it drops and hits that level, okay, either 62 or 70.5. You can be a hard ass and wait for it to go down to 79, but many times it doesn't go there. And you'll see once I open the colors up, you can see actually here, it never went down that low. But I like to anticipate it reaching to 70.5 for optimal trade entry, but my entry most 90% plus times is right at the 62% trade zone level. That's what I'm looking at. That's the price I'm trying to get. So either I'm trying to wait for it to trade so it allows me at market to get that price, or I use limit orders at or just above the 70.5 level that will get me at the 62 as an entry. The risk is defined right at the old low. Why am I comfortable with putting it right at the old low and not 10 pips below or 5 pips or 20 pips below it? Because if it's going to go below the 79% trade zone level, it's going to run the stops below that low anyway. And I don't want to have too much risk below that low late at opportunity for them to take that from my account, because it could skip and gap down and hit that, and too fast of a movement for me to save the stop. So I have my stop right at the low. So if it does skip and jump down there, I'm not going to weather 10 or 20 or 30, 40 pips below that low, depending upon how your trading teacher taught you with an old low, putting a stop below that. I'm going to be right at that low, because in this condition, if I'm bullish, it should not go below 79. If it goes below 80, I'm wrong. So I'm going to collapse the trade personally, and I'm going to save the stop. So now what did I just teach you? Cut your losses short, define your risk, know your objectives, how to hold on for them, I've replaced a lot of bad thinking and toxic thinking you probably had or didn't even know what you're looking for in terms of price action. I've given you a complete model of how to interpret price, replace bad habit thinking, and replace it with the things that you're supposed to be looking for. What it is that you're focusing on primarily. So with that in mind, let's go into, really? I know there's some people that are not inside my group here, and your news is the first time you're here. Get to the meat of it. Get to show us the account since you made your video. Really? All right. I'll use this. I'll set it like I usually have. Bull candle. And bear candle. Okay, and that's what price looked like in reality. So you can see how price rallied up to the 79% retracement level of the retracement leg. This is first profit. Okay, then it price trades up to the old high. There's an objective there. Here's an objective here. It hits that, and then finally hit the 162 extension. So all this unfolds with the idea that you have to believe that the market's going higher. So that means you have to anticipate, the market moving higher, wait for it to happen, don't rush. When it does retrace, know where you're going to be looking to take the trade. Stop loss run here, turtle soup entry. It doesn't have to be optimal trade entry. This could be your trading pattern here. This old low being violated when it's bullish. There you go. As this is all free tutorial stuff. But the problem is many of you are trying to do too many things and you're worrying about the wrong things. And by having the right perspective, applying it, doing it consistently, then and only then will you overcome bad habits and replace them with positive. Really? All right, look. This is not why I had you here, but the account now is at 15,281. I did a little movement in the euro this morning. You can see the last one I got stopped out at on that video, and there it is. So no, I haven't taken any losses I'm hiding from. So please don't send those things. You guys worry about the wrong things. Anyway, so hopefully this is giving you some framework to work within in terms of developing the right mindset and overcoming bad habits. Obviously, there's a lot of things that could be answered or discussed, and I could probably go on and on, but I don't want to spend any more time than I've allotted for. So all I want to know is have you had any kind of, if you've had any ideas stimulated, if you've given at least a context of how to use it, that would be, appreciate if you share it with me in the comment box. I didn't want to do this, but let's go through real quick. There's the trade, and you can see how it's very similar to what I did with the cable idea. I went long here. You can see the trade idea. I just had it up here. Let me show it to you one more time. You can see it, so it's not me adding a line and putting all this stuff here. I did a long here. I had an objective getting up here, and we had a price drop. I did an extension, or not an extension, but a fib from the high down to the low, and it rallied back up. And once we got to a level that would be reasonable for optimal trade entry as a potential reversal, that's where I was scaling out at. And my initial scaling was just half. I took 2 of the 4 I bought initially down here because I was unsure about the willingness to want to go higher. So I was paying myself even though I was wrong. You have to learn to be profiting when you're wrong about your outcome. If you don't see the things panning out, you need to at least know how to get that out of the marketplace to pay you. I had a point of entry. The market rallied up while I was sleeping. It didn't hit my limit order. It didn't give me the objective to move higher. We dropped down. I woke up and I saw price trading at this level in here. I gave it some time. And once it moved into a level retracement from this high down to the low, I scaled out. And it didn't give me any more positive movement. So I scaled out another portion. It didn't give me any more, and I just collapsed the trade. And did I do the right thing? Yes. Was I wrong about the trade? Yes, because I thought it was going to go up here. Did I lose money? No. Did I make money? Yes, in demo. For disclosure, I'm teaching through a demo account. But this is what you do. You have to have, drop the ego. Leave the I got to be better than the next guy attitude, or I have to live up to some measure of expectation to be profitable. No, you don't. It's about making more deposits in the account than withdrawals. That's all this is. But there's a lot of room for flamboyance. There's a lot of room for pomp and arrogance. And believe me, I'm a showcase for that. But if you try to do those things and try to make it manifest into profitability in your trading, many times it's going to be a barrier. I've been doing this for 23 plus years. So I know me. I know the markets enough where I can play around in it. New traders don't have that. And they can get in trouble wearing their ego or trying to be a big shot and pretending to know something they don't. And when you look at their accounts or they look at their trading, it's pretty apparent they don't know what they're doing. But the long and short is there's plenty of bad habits I didn't list today, but the ones that I talked about and covered today, they're the ones I had to actually endure and wrestle with. And what I ended up doing by showing at the end of this video and this presentation was what I actually did to overcome it. Know what I'm looking for, know how to define the risk, know how to pay myself when I'm wrong, because you have to do that. And this is an example. I was expecting euro to go higher. It didn't. But I knew how I was going to react to it failing, not chasing price or freaking out. I woke up. I would have had a wonderful opportunity to get at a higher price, but I was sleeping. My limit order was doing its job up here should price trade there. My stop loss was already at a point where I couldn't lose. And the long and short is, I woke up, I saw the market had dropped down. This could have very easily stopped me out at, well, my stop was a little bit lower than here. But at the time when we started rallying up, I moved my stop to a point where I couldn't lose any money, and I watched and I managed how much of a retracement we're getting here. And it was stalling between this high and this low. So I had to pay myself. That's what this leg is here. And you can see I'll add all the other ones. And you can see all the portions of which that I took out for the remaining balances. So the long and short is I was wrong, but my account showed positive deposit. It doesn't have to be I'm right all the time. You're never going to be right, ever. Because had I been right in terms of my directional bias, and it hit this level and it took out my target, and it went 50 pips higher than that, online I'd have 1,000 people saying you didn't hold it the right way. You didn't get to this level, ignoring the fact that it was a positive deposit going into the account. So everyone on the outside of you are going to have all these opinions about what you should be doing when they can't spend your money, and they sure as heck ain't going to help you if you lose money. They're not going to get, hey, I feel sorry for you, pal. Here's some money. They're not going to do that, but they all have an opinion about what you're doing and what you should be doing. Unless they have given you something of value in terms of education, an opinion, or money. Okay, there's nothing wrong with someone giving you money. If they give you money to help you, okay, great. But otherwise, their opinions don't matter much at all. But because a new trader's mindset is, if somebody tells me I've been trading, they've been trading longer than me, when I was a new trader, right away I knew that person had more experience, and I want to listen to them. But I wasted so much time listening to other people when all they were doing was pretending. They had no idea what they were doing. They were selling this idea to themselves because they couldn't make money in an account. They went online and pretended. So the last thing I'm going to close with is know who you're getting the information from. Okay, it's one thing to listen to somebody that may sound genuine, may sound very well-intended, but there's a lot of well-intended sounding people out there that are clueless. They have no idea what they're doing. And you'll know right away if they have any idea what they're doing, if they teach similar, very, very close to what I've taught today. Number one, reality, you're going to lose. You have to have the right perspective, and toxic thinking is easy to replace once you know what it is that you should be doing. But most people don't know what they're supposed to be seeing in the charts or how they're supposed to operate from a personal standpoint, like a personality trait, whether it be a short-term trader, scalping, swing trader, day trader. All those things have to relate directly to your personality. And if they aren't, you're going to have adversity in your trades because you're going to be wrestling with holding on to something that your comfort level doesn't promote, Like, I can't be a long-term trader because I can't do it. My personality is too short-fused. I make decisions too quick. So I do day trading and short-term trading because it makes sense for me to do it that way. I tried it. I can't do it. So I'm not saying because I can't do it, that's the model for everyone else. I'm just telling you statistics prove that that's why people fail. They try to do something they personally can't align themselves mentally and psychologically to do. And Larry Williams did a study on this, and I didn't believe it at first, but after years of trading, I'm 100% certain he had it right. You have to match up your personality and the way you live your life. If you're fast and quick and witty, chances are you'd be a great day trader. You know, if you're an adrenaline junkie and you're out there doing all kinds of extreme sports, again, that's a day trader scalper's model because you're engaging constantly. A more passive investor's mindset where you really want to avoid drama, you want to avoid excitement, you probably do very well as a swing trader or a position trader. And day trading just isn't going to work for you because you think that it's too much noise on the lower time frame. It's not noise, it's volatility. And that same volatility that would scare you away as a position trader or a swing trader is a wonderful wonderland for a scalper or a day trader because they can work in that model of volatility and be able to find setups, find ways to be able to pick out buys and sells. So you have to do a lot of work in terms of knowing your personal self, okay? So I'm going to escape. Wish you all a very pleasant day. Appreciate you coming out. If you didn't learn anything, I apologize for wasting your time. If you did, let me know in the comments box and send it on Twitter. Let me know. I appreciate that. It is recorded, so I will throw this up on the YouTube channel. That way everyone can talk about me on there and spread the word that I'm at it again. So I will catch up with you when I catch up with you. No promises when the next one's going to be. I just want to give you guys a shout out, let you know that I do have that Twitter account. It is mine. No one's holding it and pretending to be me with this one. So I am ICT is the Twitter handle. And in October, I'll be a little bit more busier than I am now. So with that, I wish you good luck and good trading.